Good morning, traders. Welcome to the Flow Show, Tuesday. Morning to Kate and Stell. How you doing, guys?
Morning.
Good morning, everybody. All good here.
Good.
Yeah.
Still
And
hot?
you, Ryan, how are you?
Yeah, all good, mate. Still steaming hot where you are?
Yeah, it's less crazy than it was a few days ago, but it's still very hot. So I'm not complaining.
Not cooking your eggs on the pavement then?
Not yet, no.
Good stuff. Right, not too much out in the headlines and stuff today, so this segment might be fairly short, but we shall kick off as we often do in China. China's Politburo, the group who make final decisions, if you like, for policies over there. They basically put together all the bits and pieces of support we've been hearing about over the last few weeks into sort of a plan roadmap type thing. So they're looking at property support, changing property rules, ownership rules, local government debt support, consumer support. So as I say, everything that we've been speaking about in bits and pieces over the last few weeks, they've put together as part of a grand plan. But it's a bit light on details still. So it's really, we've heard more from the news press pieces of late than we've heard from these guys. But they're the ones who make the final decisions. So we've got to take it as it comes. But also the market has been looking at this, and the standout from it is that there's been no large stimulus or monetary policy measures pushed forward as to how they're going to go about this. So at the moment, it's all still grand plans, but lacking in detail. China Z came out after and said they will strive to achieve the annual development goals. Following that, China's Forex regulator said they will relax restrictions on upfront costs for overseas direct investment. You remember they loosened up their ratio for moving funds between multinationals around China. So this is something a little bit to do with that as well. So as you can see, we keep getting these little bits and pieces of stuff they're doing, but they're not going blood and thunder on the stimulus just yet. They all want to do a bit of tinkering. The PBOC fixed their rate at 7.1406, keeping it at that 7.14 level. The prior fix was 7.1451. Expected was 7.2044, so still fixing well below where the market's seeing it anyway. And China's banks apparently were in the market again, selling dollars and buying yuan overnight. Dollar China is dropping again, back down towards that 7.12 area. Pretty much as I was saying last week, I think it's looking very clear that we've got a potential top in play now. Didn't really get a look up towards these highs that I was looking for, maybe to get some shorts on, but it looks like for now the party is over in terms of gains in this, unless they do start hitting some big stimulus measures. I think we might get a last hurrah if we get a sudden RRR cut. That's likely to see dollar China ramping up again, but I don't think we're going to be breaking those highs anytime soon unless something significantly changes on that front. Over in Japan, and the government expects fiscal year 2024 wages at 2.5%. This is versus 2.6% they expect for fiscal year 2023. So keeping wages elevated over there. We do know that the last wage round, if you like, came in at around 3.8 something percent. There's different measures they look at, how these guys calculate it, but it's still positive in that they want they expect to see wages coming in fairly strong. Over to the data this morning, and well, actually we'll look at yesterday. Start with the PMI that we got in the US, if I can find it. Where are we going? There we are. So a little bit mixed on the numbers. Services down, but still posting a healthy number there, still in expansion. Manufacturing was expected to improve a pip, but it improved more than a pip, up to 49. Still in contraction, but only one step really, if there's going to be a bounce in manufacturing, one step really from going into expansion again. So not as bad as we've been seeing in some of the other European numbers in terms of manufacturing. So you could take that data overall as potentially being a bit positive, even with the softness in services, but certainly not as bad as what we've seen in Europe. This morning we got some more data from Germany, the IFO business climate index, and unsurprisingly it was worse than expected. Things are really looking a bit dour in Germany. Came in at 87.3, current assessment 91.3, and expectations 83.5, which was actually a beat of expectations depending on what calendar you were looking at, but it was all still down on last month. So things not looking too good in Germany. Over to the Fed, and we did get a ForexAnalytix piece yesterday saying that the Fed isn't ready to declare victory on inflation. It was a bit light on sources. The tagline was that some Fed policymakers and economists are concerned that the easing in inflation will be temporary. It didn't go on to name any officials or make any strong recommendations that officials have been dropping any hints to our mate ForexAnalytix. It was all mostly about economists. So a bit of a fluff piece, if you like, as opposed to getting a nod that on anything to do with the FOMC this week. Now, over in to do with Fed hikes, Reuters had a piece out, and something we've been talking about the past week or so, couple of weeks on this show, on the Face and elsewhere. And that's the investors seeking yield. If they think rates are going to top out in the US, for example, more passive investors are going to be looking to lock in yield, so money that they can sit on for a while rather than keep it in cash. You know, they can stick it into 2-year bonds up at 5% mark, sit on that money if they think that interest rates are going to come back down. Well, Reuters pick out that dividend stocks, high dividend stocks, might be back in fashion as well. So there's another place for more passive investors to stick their money in, earn a dividend, earn a decent yield on that money, maybe more than they would if they left their money in interest rate specific assets. So another bit of a switch around for investors in that one. And this is what we're going to see in markets a lot as everyone tries to guess what's going on with central banks. As I say, you get these more passive investors who just look to park their money up and earn a decent return on it. And they will switch around. If they can get 0.5% better somewhere else, they will do so. And that causes a lot of flows, or can cause a lot of flows in markets. Over to the Bank of Canada, and a survey on what's expected over there, and most Canadian market participants see them holding rates at 5% until the end of 2023, and then starting to cut rates in March 2024. So here we go with the old cut calls coming in already for the Bank of Canada in the main, and we're going to see similar for the Fed, no doubt, at some point. Guys, you got any headlines? Because that's me done. Not too much going on to pick it up.
Not really.
Okay, got anything crossing your wires?
Well, on news, or you want to talk about the ECB?
Oh yeah, we had that lending survey.
Or there's a lot of
the survey
stuff as expectations. Now, I've just got a couple of comments on. First of all, what happened in China with those banks coming, this Chinese submarines selling dollar yuan. It does look as they want to try and put the dollar CNH under the PBOC fixing. It just feels to me that they would like to do that, because that's a bit of a psychological barrier or measure point, shall I say. We've had it earlier in in July as well, and that dropped down to 712. And this morning again, we went into the 713s. So now we're back into the 714s. The PBOC fixed 714. What is it? 05 or 6 or 7, something like that. It does seem to me like they want to force the market to say like, hey, the stimulus they are going to do, plans putting in place for the building societies and stuff are looking better. So look at me and try to and buy my currency instead of continuously selling it on what stimulus usually does, is to water down a currency. And I think it's we had a bit of an interesting development, and I particularly want to look at it in ahead of the FOMC, for instance, because then you talk about as well the dollar side. If you get an FOMC which is, let's say, neutral to slightly hawkish, I think we are going to see that dollar leg higher, you know, in dollar CNH. But if in turn Powell signals that they are sort of done, and then we may be seeing another round, you know, the next night of the Chinese submarine selling dollar yuan, then they may possibly break the camel's back, you know. It's going to be an interesting week, I think, for dollar CNH from that respect. Before I left for my absence, the but people in the room know I was actually a bit short dollar CNH, but I took them back because I saw the moves in the rest of the dollars and perhaps running a bit out of steam, so I took them back. But this week to me is going to be a very interesting week for stuff like dollar CNH, because it's going to be a twofold interest. Is that, are they succeeding to lure in investors or speculators back into long CNH and short dollar China, in which case we should see big pressure being put back onto the 7 psychological level? Or is the market going to call the bluff? And in that case, then I think we may be in for fresh highs on this round. Not the prior highs perhaps, but on this round it could be. So to me it's going to be an interesting week for the Chinese yuan on that side of the market. And then regarding the articles that we see around yield seeking. Let's not forget, it's been going on for months, right? We have seen huge inflows in money market funds over the turn of the year already, and so there's already a lot. In my opinion, volume-wise, there's already a lot done, or there's already a lot of money parked in there, because we saw the RRP coming up, but then the money market funds volume and assets under management getting ramped up massively. So I don't know how much this thing is sensing end of Fed hikes article a bit behind the curves, or just trying to rehash a story. But I'm personally not going to take it as a sign that big investors call the end of it. It's just
but it's I think it's like often we see in markets, you always got the last minute.com as the late ones to the party, you then start jumping lily pads, if you like. Sorry?
Yeah, I'll be back in 2 minutes.
Yeah, okay. As I was saying, you always get the latecomers to these types of things, and it's a question of just jumping from lily pad to lily pad, really, and moving money around. I'm not saying that all the market's going to be doing it, but there's always people who are coming late to these things. And one thing I did miss is that we had the ECB survey on credit, and business demand for credit dropped to the lowest since the survey started in 2003. So another sign of tightening financial conditions in the Eurozone. Although banks expected a much smaller decline in credit demand from firms in Q3, they said that access to funding, especially retail conditions, deteriorated in the second quarter. So a bit of tough news for the ECB. This is something that all central banks are looking at, these tighter financial conditions and its impact on borrowing, lending, liquidity, that sort of things. So this is something that the market has again drawn down expectations for the ECB, particularly for a hike after this week. Euro has been suffering because of it, if only mildly, just making a fresh low as we speak though. So it's keeping the pressure on. It's something that the market's going to be thinking is going to come up in conversation, or will come up in conversation at the ECB meeting. Is that enough to put the ECB into a pause after this hike? Some might say yes. I would say potentially not. There's no way they're going to give up the fight on inflation, or sound like they're going to give up the fight on inflation. And remember, inflation is their mandate. Price stability is their mandate. It's not lending conditions, it's price stability, and that is keeping inflation close to 2%. We saw the core CPI number going up. Now, the thing that you've got to take into account with all these central banks is that they can say the fight on inflation isn't over, and they can use that as an excuse to keep rates higher, take rates higher. It's okay for them to be wrong on this side of the trade. It wasn't okay for them to be wrong when they were telling us there was no inflation or it was transitory. It's okay for them to be wrong on this side of the fence, because if they are wrong, inflation has gone the way they want it to, back down to target. So not having to hike again would be a win for these guys, even if they're telling us they will hike again. As I say, it's opposite on the other side to when they were telling us inflation was transitory and they weren't hiking fast enough. That did a lot of damage that we're seeing now. So they can tell us all the stories that they like on this side, and they can be wrong and it won't matter. And that's the difference in the two trades there. But anyway, those lending conditions are going to crop up at the ECB meeting. And as I say, will it be enough to tip them into a pause? We shall have to wait and see. So while we're here, we'll stick with the euro. Let's get onto a proper chart first. So we're seeing more softness here. As I said, coming in, the German data not helping at all. That survey not helping at all. I'm loath to see this as anything other than reactionary to the data and whatever, and the drawdown in ECB expectations. It could all change over the ECB. They're either going to confirm what the market's thinking now, and perhaps we're heading lower, or they come and stamp all over it and we bounce back up again. So really, I'm not keen to be trading too much around these moves unless we get something really juicy. I might try a little scout off the 110 if it's seen today, just purely from a technical trade, but I'm not going to give it a lot of room. Under 90, I'll likely be out. Then, do we get a move down to the old zone between 108.30, 108.70? What will happen down there might be another area to look at for scalps. Euro sterling as well is nestling down to the 86 handle. Let's get a little bit of a short-term chart there. Stick them on an hourly. So the area starts from around 86.10 down to the big figure, and we've had a little mooch down there. Just pretty much got close to the big figure over the IFO. It's not bouncing too much at the moment, so still under some selling pressure here. This one I'm going to have on my radar. If we get a move under 86, maybe down to the mid to low 85s again, I'm going to be looking to add back into my longs. I think this is going to be strong enough to hold any ECB dovishness if it's perceived as such. I still don't think they're going to be dovish. I still think they're going to maintain a positive hawkish stance in their meeting. So I'm still happy to be in longs in this one, and maybe get a reaction to my thinking on that, and we move back up. Still, did you want to have a look at any charts today, or?
Yeah, I can do that. Yeah. I can do that ahead of tomorrow's.
I'm really not looking at a lot personally, so I've not got much to add specifically, but I'll just highlighting levels here and there.
Yeah, no, it's similar with me. I mean, I'll show some charts, but we are ahead of a big decision tomorrow, which is the Fed. And when I say decision, I mean we have some instruments which are at very important levels. 10-year US is one. We've been looking at this descending trend line of breakout, came back down, now back up. So basically, it's trying to make up its mind whether this is going to be a false move higher or if we're going to be, and by definition, we move down toward 330 or we move higher, which will have all sorts of consequences, I think, for effects, for equities, for everything. So my scenario, my base case scenario is that the Fed will have to hike. I personally don't think they need to hike because of the way inflation and price pressures have been dropping quite dramatically recently. And it's not just CPI. It's also the leading indicators, which are weak. 9 out of 10 numbers have been weak. Employment is still relatively okay, but we know that this is the last thing to turn, and it's a very lagging indicator. But the Fed were very slow to act when inflation was picking up. And like you said, Ryan, correctly about the ECB, I think every central bank will probably err on the side of caution, meaning they will rather over tighten than under tighten, but I think that's probably going to be a mistake. My opinion, if I was Fed chairman now, obviously I would have done things a lot differently, 2 years ago, or a year and a half ago. But now I would be probably inclined to say we've done enough for now. Look, indicators are really turning lower, and the economy is going to start to struggle. So let's see where inflation bottoms, because the recent trend has been lower, and 3% headline CPI. We could very easily get to 2% within a few months. So that's my view. But I don't, I think even though the central banks want to be dovish, I think on this occasion, because they had been so wrong about inflation on the way up, they might try to overdo it. So I think 25 is done for tomorrow, fully priced by the market, and really would be a massive shock if they don't. And but the question is, what do they tell us for the moves later? And I think that's where they're going to prepare us for a coming pause. And I think Timmy Leaks is right that there is now a lot more reason for central bankers to be cautious to the dovish side. And I think that's what we're probably going to see, and that's why I think yields are not going to be rising, and I think yields will turn 10-year. I think will go towards 330, at which point it's going to have to make another very big decision. It will depend on how the U.S. economy is going, because we are pricing cuts now in 2024. We were saying a few months ago that pricing cuts in 2023 is a bit far-fetched, and they're now being taken out naturally. So cuts in 2024, I still think it is a little bit far-fetched, but the economy could turn lower in a big way. So if that happens, they're going to be cutting. But for now, I think more of these cuts are going to get pushed maybe towards the end of 2024, and then we see. But tomorrow's Fed is clearly the main event. My base case scenario, as I said, is that yields go lower, which means that the Dixie, which is also at a pivotal level. I mean, look at this zone here between just under 101 and, just under 102, 101 to 102, let's say. It's massive. And we did break down. We made new lows for, over a 12-month period, new lows. So that's important. But what happens now? If the Fed is not dovish, if they're in any way hawkish, then this is going to be a false breakdown and all hell is going to break loose. Because I was watching couple of charts that was it Jim Welch? I think he posted very short speculative position in the dollar, and also very long speculative positioning in hold on, bonds have reversed a bit. No, the main one is the dollar, and it's very short. So is it ripe for a squeeze? Yes, based on positioning. But if the Fed is dovish, it doesn't matter that I don't think it's going to matter that the market's very short the dollar. I think it's going to continue lower, and then at some point, obviously, there will be a relief rally. But I think the first move will be to go towards these lows and take them out if the Fed is dovish. So the Dixie is again at a critical level here. I'm not treating this as a false breakdown yet, same way as I'm not dealing the 10-year US as a false breakout yet, because we have the Fed tomorrow and it's absolutely huge. My base case scenario is that the Fed's going to be dovish, as I said before, so the Dixie I think is going to turn lower. But of course, if I knew for sure, I'd be a trillionaire. So that's what I'm looking at. I did actually just before we I'm going to move to metals. Just before we started the flow show, I took out a third of my silver longs ahead of tomorrow's Fed. It's gone just over 6%, so I like that. I am still running the other 2/3. It is an important level here. I mean, look at this. 2450, 2460 was the highs from January, February, then the lows from April, then again highs from June. This is very important, and this could break one way or the other. I think it's going to break to the upside, but you know me, I always like to bank a little bit, and I wish all my trades go 6% within a few weeks. But I am doing that. I want to err on the side of caution, because if the Fed is not dovish, then silver will easily get back towards 23, maybe even mid to high 22s, because the market is going to get spooked. That's how it always does work. So the metals. Sorry, go on.
Yeah, you should put your CV into the central banks, mate. If you err on the side of caution, you're in the right timing now to be a CBer.
Yeah, that's I wouldn't want to be in central banks, tell you what. But yeah, these markets are very tricky. So I always say, to my friends and to people I talk to, always err a little bit on the side of caution. It doesn't hurt, because they are very unpredictable, and you get stop hunts all the time, crazy action. So I always say, when you're in the money, and if you're nicely deeply in the money, I always take some off and try to unload and reload, etc. You've seen me. I mean, Kay, I know you do the same. Anyway, so talking about metals, my base case is that they go higher. I think that's unavoidable. Gold has been trading a lot better than silver recently. I mean, I said this so many times before. Last year and a half, we've seen very, very big tightening and dollar rally. Okay, yes, recently dollars come off a little bit, but overall tightening. And look what gold's done. I mean, it's still about $100 off its all-time highs, which is absolutely a monster performance, in my opinion, any way you slice it. So the minute the Fed and the other central banks turn dovish, I think this goes straight through. I am not trading gold at the moment. I still have my coins, but I am concentrating on silver at the moment, because it moves a lot more, and I think it has a lot bigger potential to the upside. I think this gold-silver ratio, it's going to break these lows, and I think we're going to go and test the low 70s and then look out below. So when that happens, silver outperforms gold, and that's where I want to be. The euro, well, that's the inverse of the Dixie, and is this a false breakout or not? We will know tomorrow. But for now, I'm not touching the euro. The pound, I'm still constructive. For those who are ForexAnalytix subscribers, they will know I took a long last week at 128.45. I moved my stops to break even when we got to 128.60, whenever that was yesterday, and then we got taken out at break even. So I'm out of that at flat, and I'm definitely going to look to reload. I like the pound still, even though inflation in the UK has dropped more than expected. It is way higher than target, way higher than the US, way higher than ECB's target and inflation, and I think that it's a close call between the 25 and the 50 now for the Bank of England, but I still think there will be central bank divergence for a little bit longer, and that's why I like the pound. Euro pound, I think it's still bearish as long as we're below 87.2. We did try to get there a few days ago. I was waiting for that to short it. We missed it by about 15 pips. It doesn't matter. It happens. So yeah, I still like the pound, even though I hear a lot of people not liking it. Ryan, and I'm kidding, don't worry. And let me pull this a little bit higher, a little bit. Come on, this is too. I'll do it later. Don't worry. Actually, no, I'll do it now. There we go. And otherwise, not much more to say. Oil is looking very very strong recently. We passed the 200 DMA, and I don't know what to do with it. I'm scared of trading oil. If you guys are trading oil and doing well, you are a lot better than I am. It's tricky. It's very tricky because there's this huge force which is OPEC and how they control production, and then on the other hand you have what looks like the global economy slowing. So what's going to win out of the two forces? I don't know. I mean, all I know is if we start getting to levels like 83, I think I'm going to try short there. But I really don't know how to trade this.
Yeah,
Any other
82.50 I'm looking at for that one for the oil.
83.50 or 82.50?
82.50.
82.50. Yeah, makes sense.
We had a series of highs and lows going back. So yeah, if we're gonna, I'm surprised we're still rallying in oil, given the numbers, particularly the last numbers we just had for manufacturing. Doesn't suggest oil should be rallying, but as we know, there's been a supply demand change. There's now a deficit apparently, but it's not a positive deficit, if you know what I mean. It's because everything is dropping rather than demand is increasing. So
whenever there's a big force that can move the market in a big way, same as the S&P with the Swissy, I always hesitate to trade things like that because you're at the mercy of these people. Dollar CAD has been trading pretty poorly, and we were talking about this break here, came down, retested. This is a textbook. I want to short this, but at around 133. So a mildly hawkish Fed might bring us there, and I want to short that, especially given the way oil has been doing well. I think the CAD should remain supported, so dollar CAD should have a lid on it. What else? The yen. I don't know about the yen, man. I mean, I don't know how you guys trade it. I want to be a seller of dollar yen. I want to be a buyer of yen, even though the Bank of Japan has been stubbornly dovish. I think with inflation creeping higher now, clearly creeping higher, they have to act at some point. And it's still a vastly undervalued currency, and I think there's a lot of potential to the downside in dollar yen, euro yen, all these yen pairs, but not doing anything yet with this. Cryptos, I mean, Bitcoin looked like it's consolidating here, ready to make a next move higher. This looked like a bullish flag nicely, and then it kind of came lower. So I don't know what to make of it. It's still in no man's land as far as I'm concerned, and Ethereum is a similar story. I mean, we had this push on the back of the ETF that was brought out, but fundamentals driving this, well, I have no idea. It's correlated with risk in a way, but and as long as equities are bid, I don't see how crypto is going to collapse. But will they outperform equities? I don't think so. I think they will continue to underperform. Speaking of equities, you tell me if this is a bearish chart in any way. Oops, undo. No, okay. Where is it? There we go. This is not bearish. I would not want to be trying to pick it up on this. And if anything, it will look like we're consolidating a little bit, like a nice little flag if you go to the 4 hour. Yeah, do I want to be shorting this? Absolutely not. Resist the temptation. I've been saying this for weeks, haven't I? And really, it is a widowmaker at the moment. So would I go in and get long this? Maybe on a breakout of these highs? Yeah, maybe. But, if you're long and if you have been long, I would stick with that and definitely would not want to get short this. Just a friendly opinion. The DAX is very near to all-time highs again. Is that bearish? Absolutely not. So same applies for the DAX and pretty much all other major equity indices. So good luck, and please try not to hurt yourself shorting these. That's it. That's it from me. Hopefully tomorrow, after the Fed, we'll have a lot more to talk about.
Yeah, thanks, mate. Okay, I'll just grab the chart back quickly.
Yes, sir.
Before I hand over to the K-Man. There, and just one I wanted to have a quick look at, Euro CAD. We were talking about this last week, having a pretty decent move above the pivot level 46.5. We're now back below. We had a little try last week on Friday, couldn't hold it, had the bounce, and now we're back below, and look what we're doing, holding it as resistance straight away. So there you go, another example of how you can trade these levels. You can look for a break, wait for the break to be confirmed. Next level down is into the low 45s, but just keep an eye on this bit of a short-term channel going on here, moving down, just showing the trend lower, at least for the last few days on that one. Another one, just want to look at dollar yen quickly, because we had a move yesterday under the 141, knocked a few stops out below there, but we got back above pretty quickly. This one's still in range, at least in terms of what we've had since that Friday story. You know, we're not giving up too much. We've had a go. It's not held. So now we're staying back above and keeping that balance I've been speaking about. Really, the exercise for me on this one is just looking at picking my levels, or trying to pick my levels, knowing where my stretch points are. I don't know what the market's going to do over the Fed. I don't know what it's going to do over the Bank of Japan, but I'm going to do my homework, and I know the levels I'm going to be looking at. If we get there, is it worth a trade? You know, down at 139, 138, you know, obviously the big levels below, anywhere up towards 144, 143.5, definitely up to 145 is going to be the areas. So although I'm not looking to do anything right in the middle here, you need to use this time, do your homework, get your charts set, clean them up a bit, whatever you want to do, have your levels, know where you want to trade if you get a move there over these events, and then hopefully you get what you're waiting for and you get in a decent trade. Ali was asking about the Bank of Japan and you know, all the moving around, yen strength, getting expectant into these meetings. You know, the market can only react to the headlines as they come across. You know, we had headlines where the Bank of Japan expected to hike inflation forecasts, talking about potential yield curve control, and the market's going to react to that. And then you get the counter headlines, you read and the sources piece, and the market goes the other way. You know, that's part and parcel of trading. So yeah, and you've also got to remember that, you know, the market will also take position off the table. So if the market's heavily short yen going into a big risk event, it will take it off the table, and that's going to cause yen strength. You know, one thing I would say is if you think so strongly about it, if you notice these things happening, you should know how to position for it if the market gets too extreme. So if you think the market is getting too long yen for the potential outcome, well, that gives you something to trade potentially. So, you know, always look at these things as an opportunity, rather than you know, just having a moan up about what the market's doing. So yeah, always prepare, always be prepared. Kay, do you want to have a little look around?
I can do, mate. I can do. Yeah, there's not really too much to talk about prior to what's going to happen. But I also saw Annie's comment about the yen. It is, we are in this period since the appointment of Ueda, and even the month before when Kuroda surprised us with a widening of the YCC. We are in this era where the market is going to expect a move of the BOJ at every meeting. So that's why you may be seeing these kind of preparatory speculation moves or people buying downside on the dollar yen, and then the hedges, you need to sell dollar yen and things like that. To me, what's really going to drive it, you've got, well, three things is the FOMC, but then to me the main two things about what's going to drive the dollar yen this week, after what we already know in the comments about inflation expectations and stuff, is really this second quarter GDP in the US coming out on Thursday, and then the Bank of Japan meeting itself. There's not 100% certainty about this one. The base case is that they don't move anything, they don't change anything, but they can change their inflation outlook. But then we already heard from Ueda that they expect the inflation to come off in the second half of this year. Now, is it the calendar year or is it the fiscal year? That's 3 months. There's 3 months gap in there. But if they revise it now, it may still be that Ueda says yes, but I told you I expect it to come off in the latter half, so we don't need to change anything now. So we are going to keep it the way it is. So there's a couple of possible outcomes in for this BOJ, and really it's a lot of speculation to take positions now, because we are bang in the middle of this setback and range, which is around 141.08, which really we are in the middle of it. So as already said, I mean, the big levels are really 145 and lower 137s if there's enough moves. There's enough moves coming out of this, the combination of everything we are going to get this week. I'd say there's already for the shorter end into it. I think 142 figure 10 and those little spike lower that we saw yesterday, or yesterday, right? Over here, 140, call it 75, 85 or 80, 90. Those are levels to already to watch going into whatever may come. Perhaps a pending order around 145. I'm not sure we're going to see 145 before the BOJ, unless we get a really big upward surprise in that Q2 GDP on Thursday. For the rest, I don't think there's enough power in anything to go and see 145 before the Bank of Japan. Maybe wrong, of course, but I don't see it that way. Well, Ryan already mentioned that EuroCat, and we were looking at it this morning. And again, we've all identified this big 146, 40, 50 zone. It's been going on since early 20, even late 2021, right? It's a heavily traded level. Every time we come around there, we can see that. So now we are back through this. There's a bit of a trend line I see here. Is it enough strength to get through? I don't know right now, but after the what we see start of this week, European numbers, and then looking at what oils are doing and energy is doing, there's a case for this to go and test those low 145s or even high 144s. I do think, and I said it in the room this morning, that that euro crossers could remain on the defensive until the day perhaps of the ECB, where if the market expects them, well, the market does expect them to raise 25 bps, we can go a little bit higher on the day itself in the euro crossers. But again, even though the mandate for the ECB is only price stability, we do see in their statements that they are looking at risks and stuff. And I'm going to repeat my call. Last time ECB was Lagarde kept her hawkish stance, and I think this meeting may be the last one, because even Klaas Knot came out saying that the level of the euro is not good for export. So it's a bit of a strange one. So on stuff, for as long as there is some positivity in the energy market, And looking at the European data, this cross, I reckon, could still be a bit of a sell on rallies. I don't know, you guys saw this short-term channel there. I'm looking at it from a little wider perspective. But if it goes through 145.5, it can go lower. If ever we get a bounce up to 146.5, I'll give it a try. Yeah, euro dollar, not a lot to say right now. Bit of support zone where we are right now, 40.50, 35.50 on the euro dollar. I think we're preparing the central bank meetings, but with some weaker EU data. So we're going to go into this stuff around, I think it must be around 61.8. Yeah, 50% is only at 109.5, but I'm sure the 50% of this one here is not too far from where we are now. I don't really fancy a position, but my own view says euro is not my favorite currency right now. Cable held quite well. Yesterday morning I was speaking about this little channel, so we went for a test. I did a little bit of a 128 test, worked out well. And I said, I told myself I'm going to take profit just ahead of this 50% of the move again, which I did this morning. So that's a few pips banked. I'm happy about it, and now waiting for what's going to happen in the over the FOMC. We just had the CBI industrial trend numbers out. They were better than expected. That explains the test of the euro sterling here at the figure. Yeah, Ryan is looking at this 86 figure. I don't particularly have it on the, must be some percentage of this move probably. Sterling is still feeling a little more, not beat, but a little more, let's say, has a little more punch in it than the euro. So I would not exclude a retest of 85.70 or even 85.40 somewhere. But I think it's going to be, I'm not sure if there's enough strength in the sterling as such to go and start breaking 85. So I know Stel is looking at 83s, but I'm not 100% sure. So if we go anywhere close to those prior lows, I may give it a try to do a little bit of a long there as well. Oh yeah, I was yesterday I mentioned this Norwegian kroner. Norwegian kroner is strengthening with Brent. We will have to wait to see, I think, what's going to happen now on the over the ECB to see where this euro NOK will go. But stay below over the ECB. This could really go back to 1080. Why not in the euro NOK? If it starts to get back above 11.35, 37 here, I think the party is over, and then we go back higher. But for as long as we are below there, it still looks a bit bearish to me. Dollar Norway.
Sorry, mate, I've got the 38.2 at 11.13.95 on that euro NOK, and we broke it, messed around with it, but we're holding below it at the moment.
Yeah, this one probably here, this green line here around here. Oh, that's 29.
Yeah, call it 11.14. It's from, where's my fib coming from?
Oh, yeah, here. This one, 11.13, yeah. 11.13.30. I have it. It's my red circle here, and it's also a prior little battlefield there.
Yeah, natural level on its own.
Yeah. And we are turning around. We're slightly below, but it's euro NOK. Yeah? It can do 200-300 points just for no reason at all. So we have to be a bit careful. I wouldn't like to start unless you want to counter trade it, and you think oil has run its course. Maybe a level here, and then you hide your stops under 11.05 or 6 or so. But yeah, I wouldn't go and start selling it here after what the move we've done, right?
11.08. I've got the 200 DMA.
Okay. Oh, I don't have the 200 in here. Yeah, I'll have I'll put it up later. But yeah, we can see here this 1113 we were hanging around. But yeah, if really, I think this move has been. I wouldn't do anything unless you want to really catch a knife and hide your stops below. But for the time being, I would really wait what ECB is coming up with. Dollar Norway showed this yesterday as well. This head and shoulder break. Target is not too far from if it works out. Target not too far from the prior lows, and if you look at this trend line, it could coincide there somewhere in the 960s. But we have to break below those prior lows here first, 994, 995. Okay. If you get back above 10, 12, 13, 14.
Sorry to interrupt. I have to go, guys. I'll see you later. Okay. Thanks, guys.
Yeah, no, mate.
If you go back above 10, 12, 13, then it's probably going to put in a higher rebound here. For the time being, this looks like, I don't know how you call it, flag pennant, whatever, but it looks like a bit flagging and possibly attempt lower again, which would probably coincide with the lower euro Noki as well, and because I'm less sure about the dollar side. As I said yesterday, MEX still doing pretty well, still like an 11% currency. I don't know why we really would fight this. We are back trading around this this little zone here. Based on my assumption of the ECB, I wouldn't be surprised if we retest the early July lows here. For as long, and as I said, for as long as we are below 1910, 12. I wouldn't really be long the stuff, but I know that people are trying to catch knives in this as well, thinking the carry trade may be over. But you're wrestling against a big carry against you, a big funding cost if you're holding short MEX for a longer period. Dollar MEX, I really don't have too much of a view, but we have to acknowledge that we stayed below this level, which I highlighted here on my chart, 1706 or 7. Yeah, for as long as you're below there, start to break above, then I think we're going back into the 1730, 1740. But for as long as you stay below this, then I think we're still looking to go lower. And that's what we are talking about, the dollar China, right? I think it's going to be an important week. Either we hold this and we're starting to move higher again. Stretch point perhaps just around 710. But if we start to go below 707, 708, then I think we're really going to be in for a very quick test of 700. But therefore, I think the investors really have to switch their mind a little bit and show confidence in what the Chinese financiers are doing over there. In turn, if we start to go back above 717 and then confirm about through 723, then we are in for. Then I think the investors are really going to call the bluff. And we're going in for a retest of at least those highs. One that I'm looking at, but I'm failing to understand why the dollar rand is so the rand is so strong. I perhaps need to catch up on some reading also, but I don't know why the rand is getting stronger and stronger. I did read that there's a lot of investment going on in emerging markets just because of carry trades, because the market thinks that the major central banks are close to stopping their hiking. But with all the problems, everything I read in South Africa is actually bad. So I'm probably closer to here, 1740, anywhere between 715 and 1740. I'm probably going to try to catch a knife if I see it there. I think that's enough for today, Ryan.
Okay, thank you, mate. I'll just grab it quickly. There was a question up from Roberto in the Q&A. I was going to ask still, but he's hopped off. Just about worrying about long positioning on the pound. I think on the back of Stereos being a bit bullish on the quid. If you're talking about the CFTC stuff, the futures positioning, okay, you need to be a bit careful with that. It's not a precursor for what's going on in spot markets. Futures market is a different beast altogether. And you need to understand several things. Firstly, you've got the difference between speculative, what's called the specs, which is the non-commercials in the report, seen as a speculative. Then you've also got the financials. So you've got asset managers, fund managers, dealers, that sort of thing, who can have an opposing position to speculators. So you have to know what is the market overall. If they're all long, then maybe you've got something to think at. If specs are long and non-specs are short, then the market is balanced and all that. But I've seen these speculative and these futures positions offside for years, particularly in dollar yen some time ago. I was following the spec stuff, and dollar yen was offside specs for 2 years, I think it was, and nothing really changed because you don't know where people are positioned. You know, it's okay looking at cable, it's just come 200-300 pips off the highs, and everyone's going, oh, all the longs are thrown in the towel. Those longs might have been in since 125. No one's going to be thrown in the towel if they're long from 125 on a 300 pip move per se. So it's not a question for me. I don't worry about positioning per se. I'll use it to determine if a market really swings around. You know, you're going to get certain sides, certain positions thrown in the towel. We saw it. I was saying it exactly that with dollar yen after we got the break back up through 139. I said, if we break that, all the shorts who have been selling it down from 145 are going to start throwing in the towel. And that's what helped get us an acceleration up. So, yeah, from that side, you can take position into account. But I wouldn't not trade just because of positioning in futures markets or anything like that. Yeah, go on, mate.
Yeah, can I add something like that to that? I've been in markets for over 4 decades now, and I've been a market maker in the major corporate banks to very, very big clients. And I can tell you one thing: the futures positions that you see in the market are just a small part of whatever goes around in a market. And positioning can be right or wrong for months, and it can look stretched, but it can go on for weeks or months, and it doesn't really mean a lot, you know. I mean, what drives the market is the change of sentiment in the bigger accounts, which is the uncertainty and the unknown that we have to face in the markets. But if you look at what the positions are and people calling stretch and stuff, really, take it as one part of your decision making to trade something, but don't bank your positioning on the back of positioning that you read in the market. If you read it, it's already too late. By the way, I mean, it's like when the NFP comes out. Good luck trading if it's really a number far out of expectations. Good luck trading the first 50 points because the algos already did it, you know. I mean, but positioning is something that is widely known and thought of and commented on in the market. But those who base their own positioning on the positioning in the market, I mean, good luck if you're against the fundamentals, because you are going to suffer a lot. And so, just out of experience, I mean, it's something that we rarely, in banks rarely looked at, unless you get one of your clients all of a sudden talking about it, and it's a big enough client to take it into account. But I mean, whatever you read on Twitter or X, you have to really take it with a big bag of salt and make up your own mind, you know. And then if you start to, where you have to start to worry about your position is where you make your own homework and with your discipline built in. If you want to be long cable, for instance, it depends whether you want to be long cable for the next 5 hours, like I did yesterday, or 10 hours, and or if you want to be long for the next 10 months, then your horizon and your pain levels and your threshold will be very, very different. So it's up to you to make your and to see what works for you as well, and to find out whether you're a short or a long-term trader. But based on positions of others, I've never made money. Really, I've never made money.
Yeah, and especially listening to the specs, you know, as I say, because they can stay offside for a long time. But you also don't know how much of those futures positioning is hedging option positions in futures, which is obviously able to do. So there's a lot of noise. It's good for clicks talking about speculative markets and positioning there, because you can read the data. You know, the Reuters, the Bloombergs, they can put up that data and say these guys are long, these guys are short. They can't do the same for FX markets, for spot markets, because no one really knows who's long or short. And like Kay says, you know, when you're talking the big firms, you're not going to find out their positioning unless they decide to tell you, and when usually that's when they're at their positioning, after they've told us or before they've told us. So yeah, you can use it for a bit of sentiment, but don't plan your trades around it, definitely. Point Ali was making about the Kiwi quickly. Kiwi, yeah, might have got a little bit of a boost from the China stuff, as the Aussie has, but as mentioned, we're still light on details. This is just a more official stance, talking about the stuff that they've been talking about for weeks now. But as you can see, you know, if you want to check what's strong, what's not, look at the cross Aussie Kiwi, and you know the Aussie's taken a lot of that because it's probably more China connected than the Kiwi is. So you're going to find the Aussie moving as much. But in terms of the Kiwi, you know, it hasn't had much of a bounce really. And you're right what you say about the RBNZ. You know, if they get, I don't know, they're on pause. They're sounding, I won't call them dovish, they're just unhawkish at the moment. But you're right, if they do turn a bit more dovish, if the numbers turn there, then you're probably going to see Kiwi suffering. That'll mean Aussie Kiwi going potentially higher if Australia is doing a bit better as well. But yeah, the bounce in this one's looking not overly strong at the moment. Let's have a quick look a bit wider out. So yeah, we always had that move up to the 64s that's still sort of washing out. The bounces, you know, are looking very weak. So this short-term trend, at least from the last week or so, sees no sign of abating. But see what happens if we get down to this 38.2 that's been a bit of a level on its own going back. Right, on that note, I hope that's answered all your questions, and particularly you, Roberto. Just in case for next time, it might be worth putting it in the webinar chat, your question, just so we don't miss it. And that's where a lot of people do their waffling anyway. So a few lessons today. Hopefully that's put you straight about a few things and guided you on your way. Thank you, as always, to Kate and Stel for their input. And thank you to you folks for coming to the Flow Show and supporting us here. Have a great day today, and we'll check in with you tomorrow. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.